Welcome back, everybody, for another deep dive.
Yeah.
Today, we are going to be tackling the world of investing.
Well.
Specifically, a report called Probabilities and Payoffs
All right.
by Michael J. Mauboussin and Dan Callahan at Counterpoint Global.
Okay.
This one's going to be a little bit different, though.
Yeah.
Not only are we going to kind of unravel the complexities of investment decisions,
Yeah.
but we're also going to explore how human psychology plays a role in shaping those decisions.
Right. Right.
So get ready for a journey that's going to equip you to think a bit more critically about risk and reward,
Absolutely.
whether you're picking stocks or just making everyday choices.
It's such a good point because this report really does a good job of getting into like the weeds of why investing is so complex.
Yeah.
You know, it's not as simple as just flipping a coin.
Right. And we've all heard about expected value.
Right.
But this report really digs into why these simple probability models don't always apply.
Yeah, especially with investors.
Especially with investing.
Right.
Yeah.
They bring up this idea of Gaussian uncertainty,
Okay.
which is basically just like when you don't even know all the rules of the game,
Right.
let alone the odds of winning.
Right.
So just like think about researching a company
Yeah.
and you start to realize there's just like too many factors
Yeah.
that you just can't predict.
You can't.
That's Gaussian uncertainty, right?
That's Gaussian uncertainty. So how do we even begin to make decisions
Right.
when we're dealing with that many unknowns?
Well, that's where it gets interesting.
Okay.
That's where the report gets really interesting because they break down expected value into two parts, really.
Okay.
Payoffs and probabilities.
Okay.
And they use really cool analogies
Yeah.
to illustrate how these things play out in investing.
I love the example of comparing human height to city size.
Yeah. Yeah. Can you walk us through that?
Yeah.
Okay. So human height follows what they call a mild distribution.
Okay. Yeah.
Most people
Right.
are going to fall within a predictable range,
Yeah.
But then you look at city sizes and it's totally different.
Yeah.
It's got a wild distribution.
Totally.
So you have these massive cities like Tokyo or New York
Right.
that completely skew the average.
So you're saying investment outcomes are more like city sizes than human heights?
Yeah, it's a little unsettling.
Yeah.
So those traditional statistical measures that we use,
Right.
and standard deviation.
Like risk.
Yeah, to assess risk,
Uh-huh.
they can be pretty misleading.
Especially in those wild scenarios.
Yeah, especially in wild scenarios. And, investing is full of black swan events,
Yeah.
these unpredictable occurrences
Yeah.
that can really shake things up.
Like that supply chain chaos we saw a couple years ago.
Yeah, no one saw that coming.
No one saw that coming.
Yeah. And speaking of unexpected disruptions,
Yeah.
they have this example of the beer game,
Oh, yeah, the beer game.
right, which is a classic simulation
Yeah.
where you basically have this supply chain for beer.
Yeah.
And even just minor changes in demand
Right.
at one end can cause these crazy swings
Yeah.
in inventory and production further down the line.
Wild swings.
Yeah. And this illustrates this thing called the Ahum factor,
Okay.
these nonlinear relationships
Right.
where a tiny change
Yeah.
can make massive consequences.
Like we saw.
Exactly with supply chains.
Just like we saw.
Yeah, that definitely makes you think twice about assuming that things will always behave predictably.
Yeah.
So we've talked about payoffs, but probabilities seem equally important in this equation.
Oh, for sure.
How does the report tackle those?
So they actually break it down into three main approaches
Okay.
to setting probabilities,
Right.
frequentist propensity, and degrees of belief.
Okay, let's break those down one by one.
Okay, so frequentist is basically looking at past data
Okay.
to try to figure out
Right.
the likelihood of something happening. Propensity is more about the inherent characteristics of a system.
So saying a fair coin has a 50-50 chance.
Right.
Because of its physical properties.
Okay.
And then you have degrees of belief,
Okay.
which is really just your own judgment, your own...
Degrees
sign
of belief, that's where things get really subjective and potentially biased, right?
Totally.
Yeah.
Especially in investing. We're often dealing with these unique situations where,
Yeah.
historical data might not be a perfect guide.
Right.
And the systems are so complex that it's impossible to figure out,
Yeah.
the inherent probabilities.
Right.
So your own judgment, those degrees of belief,
Yeah.
becomes super important.
But doesn't that open the door to all sorts of errors?
Oh, yeah.
I mean, the report mentioned we tend to be overconfident
Right.
in our predictions.
Yeah. And that's why they emphasize the importance of base rates.
Okay.
So instead of just going with your gut about a company's future sales,
Yeah.
you should really look at the probabilities of these similar events happening.
Right.
In the past, So like what are the base rates for, sales growth
Yeah.
for companies like
Well,
that?
companies like this.
It's like a reality check
Yeah.
against those gut feelings.
So it's about calibrating our intuition with historical data.
Exactly. Using base rates.
Yeah.
Along with things like, sensitivity analysis and simulations.
Right.
Can really help you like widen your perspective
Yeah.
and avoid overconfidence traps.
Okay.
Uh,
Yeah. Cool. So it sounds like we need to be really careful not to get too attached to our own prediction.
Yeah.
But even if we're wrong, like, is there a way to minimize the downside?
The report talks about like having a margin of safety,
Okay.
which basically means, making sure there's a big enough gap between like what you paid for an investment
Right.
and what you think it's actually worth.
Okay.
The cushion can help absorb some of the impact if things don't go exactly as planned.
That makes sense. So we've got expected value, these wild payoffs, the importance of probabilities and base rates. Yeah. And then, this whole human psychology element.
Right.
So how do we actually put all of this together
Well,
to make like smart investment decisions?
that's where the report takes kind of a turn
Okay.
and introduces like two approaches
Okay.
to maximizing returns
Right.
that at first glance seem kind of contradictory.
Okay.
I mean, variance optimization and the Kelly criterion.
Two different ways to play the game, so to speak.
Yeah, exactly.
Okay. I'm intrigued.
So think of it like this.
Okay.
Like imagine you're in a casino
Okay.
playing a game with a biased coin
Okay.
that lands on heads more often than tails.
Okay.
Mean variance optimization,
Okay.
which was kind of championed by Harry Markowitz,
Okay.
says you should balance your bet size
Okay.
based on your risk tolerance.
Okay. So like how much risk you're comfortable with.
Right.
All right.
But the Kelly criterion kind of says something different.
Oh, so is it saying go all in?
Well, not quite.
Okay.
But it does suggest a more aggressive approach, one that aims to maximize the geometric mean
Okay.
of your returns over time.
Over time. So it's playing the long game.
Exactly.
Okay.
It's like saying, okay, I'm going to accept some volatility in the short term
Right.
to increase my chances of ending up with the most chips at the end.
But wouldn't that be incredibly nerve-wracking?
Oh, yeah.
Especially if you like hit a losing streak early on.
Yeah, totally. And that brings up this whole idea of ergodicity economics.
Ergodicity economics, that's a mouthful.
I know it's a big word,
Yeah?
but it basically means that what's true for the group
Yeah.
isn't always true for individuals.
Right.
So even if a game has a positive expected value overall,
Okay.
a single player could still lose everything
Wow.
if they're not careful.
So how do we know which approach is right for us?
Right.
Like mean variance for the cautious folks
Right.
and Kelly criterion for like the daredevils.
Well, it's not quite that simple.
Okay.
The report emphasizes that markets are mostly non-ergodic,
Not our
meaning like what works for the crowd
right
might not work for you personally.
for you personally.
So applying the Kelly criterion,
Mm-hmm.
it requires a really deep understanding
Yeah.
of the specific probabilities
Mm-hmm.
and payoffs involved.
Right.
And even then, you need to be really careful with risk management.
So no easy answers.
Yeah.
Just a deeper appreciation of the complexity, it seems.
Exactly.
The report also mentions this thing called volatility drag,
Oh, yeah.
which sounds kind of ominous.
It can be. Yeah.
Okay.
It's like this,
Sure.
a stock with high volatility
Yeah.
might have a great average annual return,
Okay.
but all those ups and downs
Yes. Right.
can actually eat away at your gains over the long haul.
Oh, wow. So volatility drag is like this silent killer of returns.
It really is, especially for like long-term investors.
Especially for long-term investors.
Yeah.
That's crazy.
And it's not just something to consider with like individual stocks.
Right.
It affects different asset classes,
Yeah.
investment strategies.
Well, highly leveraged investments,
Okay.
like the ones that amplify both gains and losses.
Yeah.
Those can be hit especially hard by volatility drag.
So trying to swing for the fences can really backfire.
Yeah, it highlights the importance of understanding how, like, volatility
Right.
and compounding interact over time.
Over time. Okay.
And remember how we talked about human psychology earlier?
Oh, yeah.
Well, it gets even more interesting when we factor in how our brains actually work.
Oh.
When we're faced with these different probabilities and payoffs.
This is where I need to buckle up because I know things are about to get complicated.
So the report describes this thing called the Allais paradox.
Okay.
And essentially it shows how people often make choices
Yeah.
that go against the whole idea of expected utility theory.
You're saying we're not as rational as we think we are?
I mean, our brains are wired
Yeah.
to seek immediate gratification
Yeah.
and avoid losses,
I can relate to that.
even if it means passing up like better gains in the long run, right? It's like that saying, a bird in the hand is worth two in the bush.
Yeah, exactly.
But sometimes that bird in the bush is worth waiting for, even if it's scary.
And there's more.
Okay.
The report also dives into this concept called myopic loss aversion.
Myopic loss aversion.
Which basically means like the more often you check your portfolio,
Yeah.
the more likely you are to see losses
Okay.
react emotionally
Yeah.
and maybe make decisions
Right.
that could hurt your long-term goals.
So maybe ignorance is bliss, at least when it comes to your investment portfolio.
It's not about being ignorant,
Okay.
but yeah, like taking that long-term perspective
Okay.
and avoiding those like knee-jerk reactions
Right.
to short-term movements.
To the market.
Yeah.
Can really help.
Okay, so we've covered a ton of ground expected value payoffs,
Yeah.
probabilities, volatility drag, and like all the psychological traps
Right.
that we can fall into.
Yeah.
What's the key takeaway for someone who wants to like apply all of this to their own investing journey? You know, this report is such a powerful reminder
Yeah.
that investing is about so much more than just like picking stocks
Right.
and hoping for the best.
Right.
It's about understanding how probabilities and payoffs work together,
Yeah.
recognizing those psychological biases,
Mm-hmm.
and having a framework to make decisions even when things feel really uncertain.
So it's not about finding a magic formula,
No.
but it's about developing this deeper understanding of all these factors.
Exactly. And one of the most valuable lessons from the report
Yeah.
is to always be questioning those assumptions,
Yeah.
challenging those biases,
Right.
and constantly refining your approach
As the landscape changes.
as the landscape changes, because it always is.
It's like we've been given a map to navigate uncharted territory.
Totally.
The real adventure is in using that map to forge our own path.
I love that.
Now, I'm really curious to hear how this all applies to different investing opportunities.
Well, that's a great segue,
Okay.
because the next part of the report actually dives into different opportunity sets
Oh.
that are available to investors,
Right.
from public equities to private markets,
Right.
like buyouts and venture capital.
Different ecosystems now. That sounds like a whole new adventure.
Exactly.
Okay, I'm ready to dive in. All right, so let's explore these investing ecosystems.
Okay.
You mentioned public equities, buyouts, and venture capital.
Right.
Like, where do we even begin?
Well, you can think of public equities as like a vast open ocean.
Okay.
You've got all
Sure.
sorts of companies swimming around in there.
Yeah.
Big, small, well-established, up-and-coming.
Right.
It's relatively easy to get in and out.
Okay.
There's a lot of information available, and it's very liquid.
So it's kind of like a high-stakes fishing expedition?
Yeah,
Plenty of potential catches, but also a lot of competition?
exactly. And the report emphasizes how competitive the public equities market is.
Right.
Everyone's trying to find those undervalued opportunities.
Right.
So it makes it pretty efficient,
Okay.
meaning prices generally reflect all the available information.
So consistently outperforming the market is pretty tough.
Yeah, it requires a sharp eye for those hidden gems and a really disciplined approach to managing risk.
Okay. Public equities, the open ocean. What about buyouts?
Okay.
Where do they fit into this ecosystem analogy?
Buyouts are more like venturing into a secluded forest.
Okay.
Private equity firms come in, acquire controlling stakes in companies,
Right.
and often take them private.
Right.
It's about restructuring, improving operations,
Okay.
and then eventually selling for a profit.
Okay.
It's much less liquid than public equities.
Right.
Higher barriers to entry.
Uh-huh.
And the investments are typically held for a longer period.
So it's like private equity firms or the forest rangers
Yeah,
carefully cultivating their portfolio companies for growth.
I like that. And while buyouts have the potential for higher returns than public equities,
Okay.
they also carry more risk.
Right.
You need specialized expertise
Yeah.
to navigate those complex private transactions.
Okay. And finally, we have venture capital. Okay.
What kind of ecosystem does that bring to mind?
Venture capital now that's like exploring a wild, untamed jungle.
Oh, wow.
You're investing in startups,
Right.
companies with bold ideas and the potential to like grow exponentially,
Yeah.
but it's a high risk, high reward environment.
Right.
A lot of those startups will fail.
Yeah.
But if you find that one extraordinary company,
Right.
the returns can be astronomical.
So it's like searching for rare exotic plants in a dense jungle.
Yeah.
Most of your efforts might lead nowhere,
You're right.
but finding that one game-changing species makes it all worthwhile.
Exactly. Venture capital requires a unique combination
Yeah.
of vision expertise and a high tolerance for risk.
Yeah, you're essentially betting on the future.
Yeah, you're trying to nurture
Yeah.
the next generation of innovative companies.
So we've got our open ocean, our secluded forest, and our untamed jungle.
Right.
How does the report help us decide which ecosystem is right for us?
Well, they actually analyze the actual distribution of returns.
For each of these asset classes.
Okay.
And what's interesting is how the probabilities and payoffs differ so drastically.
Okay.
So for instance, venture capital has the most extreme distribution.
Okay.
There's a high failure rate.
Right.
But the potential returns are incredible.
Okay.
Sometimes over 100 times the initial investment.
Wow.
Buyout returns are a little less dispersed.
Okay.
And then public equities fall somewhere in between.
So our choice really depends not only on our risk tolerance,
Right.
but also like our desired return profile and how long we're willing to let those investments grow.
Absolutely.
Yeah.
And the report makes another really important point.
Okay.
What constitutes skill in investing
Yeah.
varies across these different asset classes.
Okay.
So in venture capital, for example,
Yeah.
it's not really about picking winners all the time.
Right.
It's more about identifying those few high-impact companies
Okay.
that can drive the entire portfolio's performance,
Even if other investments fail.
even if a lot of other investments fail.
Mm.
They compare it to baseball.
Okay.
You know, a batter with a low batting average but a high slugging percentage
Right.
can still be incredibly valuable to a team.
So it's like being a talent scout,
Yeah,
looking for the next superstar athlete.
totally.
You might have to go through hundreds of prospects that don't make it
Right.
to find that one exceptional player.
They actually use those terms.
Really?
Batting average and slugging ratio
Hmm.
to describe this. So a
Okay.
high batting average means you're consistently picking winners.
Right.
High slugging ratio means you're generating those huge returns,
Yeah.
even if you're not always right.
Even if you're not always right.
The key is to align your approach with the specific characteristics
Yeah.
of the asset class you're investing in.
This has been a really eye-opening conversation.
It has.
As we wrap up, what are your final thoughts on how this report can help someone become a better investor?
You know, I think this report really drives home the idea
Yeah.
that investing is not about following simple rules.
Or chasing the latest hot trends.
Mhm.
It's about embracing the complexity of probabilities and payoffs, understanding how those different opportunity sets work,
Yeah.
and recognizing how much our own psychology can influence our decisions.
So the journey to becoming a successful investor
Right.
is less about finding a magic formula
Yeah.
and more about cultivating this deep understanding.
Exactly. And perhaps the most important takeaway
Yeah,
is to always be questioning your assumptions,
right.
challenging those biases, and refining your approach
As the landscape changes.
as the landscape changes.
Yeah.
Because it always is.
It's like we've been given a new set of lenses
I love.
to view the world of investing, and the real adventure
Yeah.
lies in using those lenses to make more informed and insightful decisions.
Well said. And remember, the journey of learning and discovery never truly ends.
Right.
The more we understand these concepts,
Mhm.
the better equipped we'll be to navigate the complexities of investing.
And make smarter choices for our financial future.
Thank you so much for joining us on this deep dive into probabilities and payoffs.
Of course.
We hope you've gained some valuable insights
Yeah,
to take with you on your own investing journey.
absolutely.
Until next time, keep exploring, keep learning, and keep diving deep.